The boroughs are New York City. The burbs are everywhere else. Real estate is the ultimate game of risk and reward. It's the biggest investment most people ever make. Fortunes are made over a lifetime and lost in a day. And we're not playing with monopoly money. How do you stay ahead? Who's buying? Who's selling? And why? What do they know? We want the truth. You need an edge. Boroughs and Burbs is your secret weapon, giving you the insider knowledge and strategies you need to succeed in the high-stakes world of real estate. From Palm Beach to Palm Springs, Manhattan to Malibu, we press the experts to expose the pain, find the deals, and occasionally predict the future. That's Boroughs and Burbs, Thursdays, 3 o'clock Eastern, noon Pacific. Because everyone can make money in real estate.
Welcome, everybody. Boroughs and Burbs 158, appraisals and lending. Such an important part of our business, Roberto. I can't believe it. You know, we've spent all this time listing a property. We finally get a buyer. They show up. They're excited. We get a meeting of the minds. And then we have to hand it over to the mortgage guys and the appraisal guys who can kill the whole deal, right?
It's like rolling the dice.
I know. And then we get mad and they're like, they don't understand. They don't understand the market. Like, we know the market. And they're like, yeah, but we understand the file, and the file is just not working for us. And I think, you know, the problem is that for a lot of us agents, we feel like it is beyond our control. What do you mean the property didn't appraise? You know, what do you mean? Wait a minute. There's a great property. You know, you just don't understand. Let me go talk to the appraiser. I can make him understand. You know, let me go talk to the mortgage guy, total mortgage. I can make him understand. So a lot of us, we don't like to not be in control of our deals. And so that's what of the great opportunities we have today is to actually ask Michael and Chuck all the hard questions about what happens when we hand them the football, so to speak, on these deals. And you know, and we rely on them to bring it across the finish line. Let me start by sharing screen and tell you that here we are, Boroughs and Burbs, the national real estate conversation. Today's episode 158, but we did the kitchen episode last week and successful buyer's agency the week before that. And I think we're heading to Dubai maybe next week. And we've got some really exciting shows in Vancouver and Miami and Florida coming up. So very excited about that. Here is a shot of our sponsor, gracefarms.org. Gracefarms.org. This is an upcoming event Saturday. They've got Saturday, November 9th, Beauty and Logic. And I just thought this was such a beautiful shot of the kind of programming they have at Grace Farms here in New Canaan. So come on up and get tickets. It's only $20 and for some amazing concerts and art programs that they've got going at Grace Farms. Okay, this is me, the engelteam.com. You'll find me. That's me and my team out here in Connecticut. And I'm happy to talk about the suburban perspective. Here is my partner, Roberto Cabrera. Brown Harris Stevens, that's his Hamptons look when he's out in the Hamptons driving a Mustang, but he's most famous for all these charts and his market reports that he does in Manhattan. Our guests today, Chuck Threshie, Total Mortgage. He's my go-to. Anytime my clients fall in love with the property, I say, go talk to Chuck, get qualified. Get qualified so you can get competitive and you can buy your dream house. There's Michael Vargas, co-founder of Vanderbilt Appraisal Company. I think you know him in Manhattan, right, Roberto?
I do indeed.
And so without further ado, welcome, gentlemen. Welcome, Chuck. Welcome, Michael. I'm so glad to have you aboard.
Thank you very much. Appreciate you having me here, and pleasure to talk about financing.
All right. I guess I'll start with Roberto. How do you know Michael, and why is he the best in New York?
Michael is such an incredible, reliable source. He's actually helped us a lot with just even pricing different things and finding comps for us when we're literally going to pitch properties as well. Michael is in the field, like I said earlier before we came on. Last time I ran into Michael, he was rolling up his sleeves and he was in the field and he was just staring at this townhouse right next to one I was trying to rent. And he was just drawing in all the information. And I asked him about a couple of things on the fly about other properties, and he knew and he followed up, and he's been amazing. And I've known Michael for years, ever since I was back with Halstead. How long ago? How long have you been at your company, Michael?
I started Vanderbilt in 2003, so 21 years.
Yeah, wow. So it goes way back.
Yeah, and prior to that, I was 10 years before that also in the appraisal business. So it's been about 30 years of doing appraisals in all of these markets. In New York City, all of the boroughs. We do cover Connecticut as well. All of the suburban markets, we basically go from the Hamptons down to the Jersey Shore and everything in between.
Can you give me a brief history of appraisals in the last 20, I don't know whether it's 20 years ago or 30 years ago, but I think your whole industry got turned on its ear. Can you talk to us about what it was like in before the change and after the change and what precipitated the change?
Yeah, I mean, there's been amazing transformations. I would say I would start, going all the way back to 1993. The first job I had was as a staff appraiser with a lending institution. I worked for a California-based bank called Home Savings of America. And they hired me as an appraisal trainee, and I was in their appraisal department every day. And to walk through, just to give you an idea of how things have changed, to walk through to my office in the appraisal department, we walked past the loan officers, past the underwriters, and then into the appraisal department. So usually on my way to work, after coming back from the field, I would run into the loan officer working on the deal and, able to give them a face-to-face update about the status of the appraisal. I could walk through the underwriting department and they might have questions about, an appraisal that we submitted a week prior to that, before getting to the desk to work on the current assignments. So that's kind of where I began. In 2008, 2009, when the mortgage market collapsed, there was a lot of new rules put into place. And the main thing was that the regulators and the government wanted to create a firewall or a buffer between appraisal and sales. And so, most of the regulations and rules that are in place now that continue to exist were put in place in 2008, 2009, where, it was no longer up to the sales staff in the loan department to be able to select, the appraiser that was going to work on their deal. And that's kind of where we are today, is that, once you submit the loan application, Chuck would have no say in who's going to do the appraisal. It's kind of a random selection process among, the approved panel that the organization might have.
That's had two effects from my point of view. One, in 2008, mind you, when an appraiser comes and says, I would like to schedule a visit to the property, I have to do an appraisal. Oh, can I provide you some comps? Can I provide you some information about this house? Nope, that's okay. I'm all set. Don't provide me anything. There is a fear about crossing lines ever since 2008 when they put these rules in place. I know that the appraisers do not want any appearance of being influenced, and the agents same thing. We don't want to seem like we're influencing, but we have some important information about the house, and sometimes we're not able to talk to the appraiser at all and give that information. Sometimes they don't want the information, and even if they do, they're very careful about, you know, what they'll accept from you and what they won't. So I have to say that the effect of the '08 rule has been a complete attitude change among agents and how we interact with your industry. The second thing is, I think 90% of all the appraisers left the business. So there's like a small minority of appraisers versus what there used to be. Is that true?
Yeah, I think that's true. I mean, I don't think it's 90%, but you know, in a lot of areas, there seems to be a shortage of appraisers.
Real
But
estate agents exaggerate in all things.
exactly.
Appraisers
All
then
right,
always kind of come back to reality. You're going to
all
see
right,
that theme
let's
throughout.
go with 90%. Let's go with
Okay.
90%. You know, I think with any regulation that's put in place, with any kind of regulation regime, there's usually over-regulation, and also, you know, misconceptions or, you know, misunderstandings about the rules. And as you were mentioning, you know, it's actually not true that agents shouldn't give information to an appraiser. And it's also not true that an appraiser should say, no, don't give me that information because that might influence me. And that's against the rules and regulations. That's not true. Uh, you know, the underlying fundamentals of the regulations are that you can't unduly influence me, John. You know, you can't offer me, you know, a nice steak dinner in order for me to make an appraisal 1 million that should be 900. And the regulations are in place about that kind of undue influence. But if you want to, you know, provide me with a packet of comps, uh, a good appraiser should be glad to take that information because, you know, what are we really there for? To study, research, and analyze market data. And it doesn't matter if it comes from the broker or our own research that we're going to do. It's data. But as long as that data doesn't come with you, you know, slipping in a couple $100 bills attached to it, then, you know, so the regulation was really meant to be about, you know, non-coercion and undue influence. But if you'd like to, you know, help educate me about the market and what you know about the comparables, that's completely legitimate.
So when I have an appraisal appointment, I always, at least for Manhattan, if it's a co-op, I give them the, you know, the financials of the building. I give them I'll give them a handful of comps, relevant, like maybe 5 solid comps, and I'll give them. They always ask for a contract of sale, which I always find, which used to be like, here's the contract of sale. This is your goal. You see that price right there? And now that it's less relevant, but it does bring something up, which I'm always curious about, because I can't tell you how often as brokers here, we go on an appointment and we go to sell something and we give a seller, for example, a range. And they say, well, we refinanced last year and the appraisal came in at this. And it's just so far off the mark. It happens all the time. And I'm wondering why. Can you speak to that at all?
I mean, it's hard to say because, you know, I mean, every market is different and every appraiser is different and every appraiser's knowledge and experience is different. With respect to the refinance, of course, you know, we don't have the presence of a contract of sale. And not that the contract of sale is, you know, a so-called target that we're trying to hit, but it is what has been presented as the meeting of the minds between a buyer and the seller. You know, there's also misconceived that, you know, as a refinance that we might be, appraisers might have a more conservative stance, you know, to make sure that the bank is protected on a loan, which is also not the case. I mean, we never really should leave our office to go to a property with any bias on the value being high or low, that we're not really there to serve the needs of the bank and that they're protected on their loan. And we're not there to serve the needs of the seller who may want to push value to get a higher loan. So, I mean, your experiences for refinances, an appraisal being lower, and then ultimately, when you go to sell it, it might be higher. Could be just a function of the difference in time period that lapses. A lot can change in a year from the time someone refinanced to the time that you're putting it on the market. And it just could come down to, I mean, no one's perfect, of course, and appraisers, come in all shapes and sizes in terms of experience and knowledge. So it's possible that, they missed the mark for some reason on the comps or the market. But it's never really, the actual intention to be, high or low for any particular need of the client. We really are there to give an objective and unbiased opinion of the value. But, with that comes how much experience do you have in a particular market? How many appraisals have you conducted? How many, as I said, I've been in the business 30 years and been in all of the markets in our area. So sometimes just a difference of experience and intimate market knowledge.
Chuck Threshie, how you doing?
Doing well, John. Thank you.
How long have you been in the mortgage business?
Interesting question. So I got into mortgage in 2017 when I invested in a startup. I've been in finance for over 20 years and made a career change to invest in a startup, and that was going to be my end game and swan song. The pandemic had a lot to say about that. So I find myself now with a really great national company, Total Mortgage. Been here for a year and a half now. After the investment kind of went away with the downturn in the market, I needed to land at a good lender. Did my due diligence and found Total Mortgage. We're the number one lender in Connecticut 4 years running. We're national. We'll do close to $2 billion this year. The thing I love most about it is not only the culture, but the breadth and depth of the products, services, our appraisal pool and our appraiser pool. I got to tell you, some of the best in the industry. So very happy to be here. And it's interesting when you were talking with Michael about how objective that facet of the business has gotten. Because I was in finance and managing 180 million in assets in 2007 and 8 when the market tanked. And so at Morgan Stanley, then we were doing mortgages, and it was an absolute disaster. And when all the rules and regulations changed between then and 2012, it really did become a blind pool. When I get a purchase contract or a sales agreement, I punch it in. We send the appraisal request out, and I have no idea what the name or who that appraiser is that's going out on my deal. And I like that arm's length removal. There's no funny business going on between the banks and the appraisers. Yes, Michael will get his hands on a contract and he'll see what the purchase price is, but he made a perfectly good point. Both the buying agent and the listing agent agreed on a price based on what they think that market will bear, right? And so then it's up to the appraiser to pull the comps and add 5% for a finished kitchen, deduct 10% for this, that, or the other thing. The litany of things that appraisers go through is quite fascinating, actually. My brother-in-law happens to be one, so I bounce a lot of things off of him when I get an appraisal back. I will tell you, and Michael may even be able to attest to this, I haven't had an appraisal gap come up in 6 to 8 months. So, or the expression, a rising tide lifts all boats. So all the comps, all the sales that have gone through at higher than, list price over the last year are now actual comps, right? So appraisals are based on actual sales. They're not based on, what's on the market and open listings. A good appraisal will look at what's on the market and open listings, but they can only base the appraisal on sold units, right? And so all those prices, we've all talked about and heard about, housing prices appreciating so drastically over the last few years. We had appraisal gaps left and right 2 years ago. And, you'd get a purchase of, call it $1 million, and appraisal come back at 850,000. That was a real problem, right? So the buyer would either need to come to the table with that cash, or the lender, myself, would have to correct it with other means. And we have what we call, an appraisal gap solution for that. And we can go into that if you want to, but basically what it means is, okay, so let's say I have a house that's sold for $1 million. I have an example here, and I kind of targeted New Canaan because that's where you are. But let's say the sale price was $1,725,000, right? And the appraisal came back at $1,725,000. Everybody's happy. Let's say it came in $50,000 short, and the buyers don't have another $50,000 to bring to the closing table. It's all in the down payment. So at 20% down payment, right, they'll put down $50,000 less. In other words, I'm sorry, they'll put down 5% less. So let's say they go from a 25% down payment to a 20% down payment. They're now making $96,000 less in their down payment. They're changing their loan to value. And they're then adding that. So the 96,000 that they did not put down, they are now taking 50,000 of that and bringing it to the table. So the loan amount went up, the down payment went down, but the cash to close actually improved by about $40,000 or $50,000 for that borrower. So basically, it's easy. If you go from a 25 or a 20% down payment, and you just take 5% off the down payment if they don't have the cash to come to the table with. And that's a way, financing wise, we get around appraisal gaps.
But that's your willingness to underwrite that scenario.
Say it again.
That becomes your willingness to underwrite that scenario.
Absolutely.
Yeah.
Now, if that scenario, and this wouldn't be the case in a jumbo loan. This is a jumbo loan, and for those of you who don't know the difference between jumbo and conforming loans are the ones that conform to Fannie and Freddie guidelines, right? The governing agencies that insure the mortgages. We have to meet those guidelines. That limit here nationally is $766,550. So over that, in this instance, it's a jumbo loan. And jumbo loan guidelines get more constrictive. You have to put more money down. But let's say you're in a conforming loan and you're putting 5% down and there's an appraisal gap. There's no room to move, right? I can't lower that down payment now to make up for the appraisal gap. So it really works well in higher down payment loans if there is a gap. But like I said a minute ago, I haven't seen an appraisal gap in 6 to 8 months. Everything's been coming in at purchase price or better.
Are you seeing the same thing, Michael, here in Manhattan for the most part?
Yeah, I mean, I think going back to an appraiser reviewing and having knowledge of the purchase price. A lot of the review of the contract doesn't really have to do with the work of estimating value. The banks really want us to review the contract to make sure that it contains typical terms for the transaction type and that it's an arm's length transaction. So it's really more about the other elements. But the sale price is one factor for us to consider. The reality is that appraisals, the reason why appraisals tend to match the purchase price is because we're estimating market value, and market value is created by the activities of buyers and sellers. It's not an appraiser who determines market value. We do report on what we think and what our opinion of market value might be based on the data. But usually an appraisal, 9.9 5 times out of 10 is likely to match the sale price because the work that goes into market value has been done by the agent, the buyer, the seller, the agent representing the seller, the agents representing the buyer. And in this day where so much is, available online, all buyers these days start their search online, so they already become educated about prices and what it might take to, win a bid for a particular property. So they already come to the table educated. And then you have the sellers who have been educated by their agent with a list of comparables that justify the asking price. And then eventually the negotiations go on and you meet somewhere in the middle. Or sometimes you meet at the high end when the market's strong. Sometimes you meet at the low end when the market's weak. And so the work that goes to develop and determine market value is really done before the appraiser shows up. And usually when an appraisal doesn't match the sale price, there's a couple of circumstances. Number one, the market is rising much faster than the appraiser can keep up with. And so if you're talking about like a 2020 to 2021 market, when there was a huge rush to the suburbs, where we saw values go from 550 to 750 to 850 to 950 to 1.1 million in a matter of not too much time. It's almost impossible for the appraiser to keep up, or even the comps to keep up. In other words, every deal is the new basis of value, and so you'll get a gap in that circumstances. And then the other time we see a disconnect between appraisal and sale prices when people decide to go it on their own, without the help of an agent. That either the seller is, doing a for sale by owner, or the buyer is just saying, I know I'm gonna, figure this all out myself. And then they may end up paying, much more than they should have.
You mean there's subjectivity on the seller's point of view on what their house is valued at, Michael?
Yeah, exactly. I mean, and the problem comes really when they're not being well advised. And so when they go it alone, or they might pick the wrong broker. But to me, it's like, as long as you're out there and getting the information from the professionals that are in the market, you usually are able to target the asking price at the right level, and the buyers are able to target their offer that's going to win them the property. And so our job becomes easier. In most markets, the job for the appraiser is not that difficult. There's enough comps and the market's kind of stable, meaning, the sale today makes sense based on the sale yesterday. There's stability in the market. But the disconnect really comes when there's a rapidly escalating market for, and prices are going high because there's 10 bids on the property that's being purchased.
I want to talk about price per foot, because with the, as you say, most people educate themselves online. It's one of the facts that Zillow, Realtor, Homes.com put right up in front. What is the price per foot? But I'm going to tell you, out here in Connecticut, the value of the house, of the square feet, is a fraction, a small fraction, a minority of the total value. On, let's say, $1.5 million house in New Canaan, there might be $500,000 worth of house and $1 million worth of land. Whereas when you're in Manhattan and you're appraising, and you see a $500 per foot price on the 27th floor, and now you have to price the 28th floor, it's much more relevant, right? It's in the same building. There's no land cost. We're evaluating how many square feet and what's the condition of those square feet. So can you talk to me about why price per foot is a lousy metric in the suburbs, and how good is it in the city?
In the city, works very well. There's definitely a correlation between value per square foot and you know, in terms of location, in terms of type of building, in terms of bedroom utility. So no, I haven't seen anything as low as 500 a foot, John.
So I was going to say, he would be every seller's worst nightmare here in Manhattan.
My information is a little dated.
Yes, let me just say, for example, you know, in the resale condo market, you know, for luxury condos resale, you probably at an average of 1,800 a foot. And so whether a property falls less than 1,800 or more than 1,800 will have a lot to do with what floor it's on, what type of view it offers, or maybe whether it's had recent upgrades. So there is a lot of correlation and a lot of you know, informative information on a price per foot basis for Manhattan. And one thing that we've been able to do over probably the last, you know, 20 years since we started Vanderbilt is really bring more transparency to price per square foot for co-ops. And, you know, co-ops don't have square footage as a matter of public record. But, you know, as more information has been out there about co-ops and listings and floor plans and the appraisals that we've done, you know, we've been able to look at value on a per square foot basis for co-ops as well, and you know, they make sense based on, you know, what you're buying and where you're buying it. And the reason why price per square foot doesn't work in the suburbs, it's part of it has to do with what you mentioned, that you know, a lot of value could be tied up in the land as opposed to the building that's on. And what that actually happens to do is that skews the price per square foot too high in many cases. So if you're looking at a house that's a tear down, you're still paying a high price relative to a small house that's on the lot. And so you might actually see a value of $1,000 a foot. And so if you're looking online and doing research and you're looking at that kind of measure and you're thinking, whoa, you know, there's you know, that's pretty high price per square foot. And then you see, you know, a big new house selling for 600 a foot. So what happens in the suburbs is that there can be sometimes an inverse relationship between size and price per square foot. So that a large 10,000 square foot house might have a lower value per square foot than a house that's being purchased for a teardown. And so there are some markets and some of the higher end markets where, you know, maybe in Greenwich, we might see a little bit more uniformity between, you know, the mansions on a price per square foot basis. But there's usually such a wide disparity in a suburban market because of, you know, the differences in size, style, design, condition, lot size. There's so many elements, but it's not unusual to find, you know, a smaller house having a higher price per foot than a larger, newer house. So oftentimes, you know, we don't pay any attention to it. It's the easiest measure of value for buyers doing their own research online to pay attention to. But you know, yeah. So there's a number of reasons why it doesn't work in the suburbs, but that's kind of one of them. Is that sometimes your more valuable property is a larger property that is going to actually display a lower price per square foot.
I'd say the biggest discrepancy in Manhattan, and the thing that's the most difficult to compare, is outdoor space, because not all outdoor spaces are made the same. Some are beautiful terraces off a living room, which is the most ideal thing, but some are on a roof up a, you know, a spiral staircase. Some are facing a back, you know, so it becomes very difficult to value outdoor space.
Yeah, and then when you're trying to consider the value of a property on a per square foot basis, which again, the price is just tied to the interior size, but that particular apartment maybe has a wraparound terrace. The terrace is creating such a premium to value that on a per square foot basis, the number seems out of whack. So for example, I was working on something where the average price per square foot these were older condos on the Upper East Side for one bedrooms was 800 to 900 a foot, and this much smaller apartment was listed and being sold for about 1,400 a foot. And the reason that disparity is just attributed to the value of the terrace. The terrace.
How about the view? I mean, I would imagine that two corners of the same building would have. Do you actually put a price on the view? Oh, that's $1 million view. Oh, that's a $500,000 view. The
You mean like
difference
the
is
view,
$500,000.
view in my background here?
Yeah,
What do you think that view is worth?
that looks like $1 million view to me.
That's a view. Behind me is a view from downtown looking north of the Hudson Yards skyline.
Yeah.
Yeah. So, when you get, and Chuck had mentioned this when he was talking about what appraisers do, is the adjustments that we make to the comparables for different amenities, different features within a property. So when we're doing a house in the suburbs, it could be about the overall condition or the fact that it has a new kitchen and the baths have been remodeled. How much extra value or less value we give for larger or smaller lot sizes. And then in the vertical cities like Manhattan and Brooklyn, a lot of it is based on size and location, of course, but then those kind of, nuances about what floor are you on and what kind of view do you have and what kind of light is the apartment getting, because those are the actions of the buyers in the market. Somebody wants high floor and open view, and they're willing to pay a premium for that. Or somebody is living on a low floor facing a brick wall and they're expecting to get that for a discount. Our rule of thumb in Manhattan for the most part is like this for an open view like this, we would probably apply a 15% premium. So it's actually two adjustments, floor level and view, 15% for view and about 1% per floor. So the difference between like the 10th and the 15th floor or the 10th and the 20th floor could be as much as 25%. And if you're getting in a refinance, going back to Roberto, what you're talking about, is that if you get an appraiser who comes in and makes an adjustment of only 5% for the view, when actually the market would bear a premium of 15 or 20%, that's how you might find, an estimated value on a refinance less than what you ultimately sell it for. The adjustments that are applied, all specific to specific markets, whether you're in the suburbs or in the city, is really what separates, the good appraisers from the average appraiser, is to know that, that a new kitchen is going to contribute, 50,000 or 100,000 in value, not just 20,000. So that's the adjustment and the value we give to all of the characteristics that generate value, or that buyers are looking to pay premiums or get discounts for. That's how you separate the good from the average.
Chuck Threshie and I worked on, I think, an interesting case study, which is relevant for talking about appraisal. There was a property that was in foreclosure and owned by a hedge fund here in New Canaan. And I got the listing and I put it out there. In addition to the house on 5 acres, there was a 2-story dairy barn, and we had to appraise it. And then we had to appraise the antique house on the corner of the property. But the antique house on the corner of the property was in very, very, very rough shape. And so what we found, I mean, you can continue the story, Chuck, but I was like, Chuck, I've got these buyers. They want to buy it. They want to finance it. We got to get it appraised. The appraisers all came in and number one said, well, in order to appraise this, we have to know, are you going to rent out the second house. What's it going to cost to restore it to being livable? Because we can't give this guy a mortgage as long as the appraiser says it's in what C minus condition. So talk to me a little bit about, Chuck, about the difficulty of financing a purchase when you have a lot of moving parts and a lot of structures on the property in different levels of disrepair and for different purposes. Barn, antique, main house, pool.
Interesting. You brought up that case study, right? So the additional dwelling, the ADU, was a cottage, right? And so when you guys already had the deal and you had an agreement in place, and you asked me to review the appraisal. So I did, and I did with my team. And then, Michael, if it comes back C6, it's unlivable, you can't finance the property, right? So it had to get into, I believe, C3 status. Is that right? Right. So C3.
So mind you, that wasn't the main house. That was, in my mind, it added no value whatsoever, but it mattered a lot to the appraiser and to the lender.
Absolutely. Right. So, and it came down to either tearing down the cottage or, refinishing or getting it up to code. Right. So I found an investor that would take on the financing of that deal if 9 items were punched on that list. And, obviously that had to go back and forth between the hedge fund owner and that's the bank and the owner of the foreclosed property, and then the buyers and what they would agree to and not do. But at the end of the day, I just took the appraisal and we tried to find a happy middle, a happy common ground where, okay, we won't bulldoze the cottage, we'll just gut it so there's no health and safety issues, or we'll do a couple of other things. But yeah, I mean, that was a
And do you have to go back to the appraiser and say, is that acceptable, or is that a lender decision? Do you have to get the C6 removed by the appraiser?
Correct. It has to be reappraised, right? So the work has to be done. Everything that's on that if you were going to stay with that lender in that original appraisal, you would have to comply with the punch list that the appraiser put on that report. If you fired if the buyer backed out of it, you got a new buyer and you got a new lender, then all of a sudden you got a new appraisal. So what we did with our investor is we went in and said, we want an what's it called, Michael? Subject to, right? So here's the appraisal. We'll do the loan at 2.3 million. And here's the appraisal, but we're going in, it's subject to all these things happening. So, right. So if all these things get done by either the seller, the bank, or the buyer who's buying it, we have a deal.
It's an incredible amount of work, and it requires somebody like you actually going and visiting the property, the appraisal, understanding the property. I mean, it's a lot of hands-on work. This is not just this is not a simple transaction. And it occurs to me that in the last 15 years, your industry also has gone through a wrenching change. A lot of the local banks have exited the business. Some of the largest lenders in the country are large national mortgage processors who resell the entire portfolio, who hold nothing on the books. I won't name names, but they sound like Rocket. Anyway, with the emergence of large national providers of mortgage services, how are they evaluating the nuances of properties like you just described? How are they getting it done with the exiting of the business of local banks?
Well, here at Total Mortgage, we are a direct lender. We're a bank, but we are not a bricks and mortar retail local bank, right? So we're called a correspondent lender. So I have a pool of 50 to 75 investors that I can shop my mortgage to. I'm not a broker because, again, we do our own lending, our own processing, our own underwriting, and our own funding. So we are a bank by definition. We are a direct lender. But as a correspondent lender, we have a pool of investors. So every deal is different, John, right? So you get an executed contract, purchase agreement, you give it to us. We order the appraisal. All that information goes to the appraiser. And then based on what we get back are our marching orders, if there are any at all, right? I mean, I will tell you, like I said, in the last 6-8 months, every single one of my appraisals has come back as is, except for yours, except for that scenario we had, right? So everyone's come back as is, which has been.
But you have to find an investor. That's unusual for the average person like myself listening here. I thought a bank is a bank is a bank.
Well, so it's interesting. So I don't have to quote unquote find an investor unless I need to meet certain guidelines. So what I do is I punch in the scenario into my system. So if it's $1 million purchase with 20% down, that's $800,000 in financing. The credit score is 750. Here are the liabilities. Here's the whole pool. I hit enter and it does it all itself. And all of a sudden the best rate within my investor pool comes up. So now let's say that comes back, and I'm not going to name names, but let's say it comes back ABC lender, right? I know right now that ABC is giving me a 6.5% rate with no points on that deal, right? So I now submit the loan to processing and underwriting. We're delegated, which means we do it all ourselves. We don't have to send it to that bank. We'll disclose the loan estimate, the closing disclosure, and everything ourselves. But we don't serve it. You talked about, that our company a minute ago that doesn't service any of their loans or hold any of the loans. We do service some of ours. We do sell some of ours. But a lot of banks, and I will tell you, not a lot, every single lender bank in the country sells some of its loans because they have to balance their portfolio. What got us really screwed up in 2006, 7, and 8 was a very unbalanced portfolio and unreliable portfolios that were structured with AAA paper, meaning good quality loans, and they weren't. They were subprime, garbage. So the regulations that came out since then to make sure that doesn't happen again are very rigid, and we follow them very closely. So the lending standards have gotten a lot more rigid, tightening credit requirements. It's really changed our industry quite a bit, and it's really, there's been a ton of attrition. You talked about, appraisers going out of business. We've lost in the last year alone 90,000 loan officers because the business is down 50 to 75%. Mortgage applications, purchases, and we don't have to tell you about inventory, right? So we're 24% lower inventory in real estate than we were pre-pandemic. It's higher than it was last year right now, so we're excited about that trend. But the inventory issues are a real grind. There's a misconception out there right now on rates. Yes, the Fed lowered the Fed funds rate in September, but we've had nothing but rates bouncing up since then based on different economic data. So where we were hoping to get into the, high 5s, low 6s, we're in the mid to high 6s again, bouncing on 7 on conforming loans. But, the beauty of what I have to select from is so I just mentioned the mortgage business and mortgage applications down drastically. At Total Mortgage, we're up 38% year over year. And we're up 38% because we are working our butts off to steal market share. And that's not just a commitment to the loan officers that are out there working with you and the consumers, but it's a commitment from management to say, hey, if Chase is offering, 6.25% with no points, I can go to my management and I say, I want to match or beat this, and we'll do it if there's anything in the deal whatsoever.
Are you guys lending on any co-ops in Manhattan?
Yes. We do lend on co-ops in Manhattan. We do not in Connecticut.
Mhm.
I'm actually licensed, Roberto, in New York as well. Michael, I just added you to our appraisal pool, so you'll be getting an email and an invite. Apparently, you weren't on our list, so you'll now be in our pool and you'll be in our database.
Looking forward to it. Thank you.
I have a question with regards to so Michael, in our market, we have a flip tax, right? And that could, let's just say, you know, I might go talk to a seller about what their property is worth, and they say, look, my property is worth X, and they say because the one upstairs sold for, you know, Y, and then when with some additional research and just trying to educate them, I'll call the broker who sold that property, say, listen, can you just tell me who paid the flip tax on that? And they'll say, well, the seller paid the flip tax. So, and this, in some of these cases, these flip taxes 2, 3, 4%, which is just a big delta in value, right? So I'm just curious if there
What
is
is
a way.
what is a flip tax?
So a flip tax originally was a way for the building to raise money. So they would levy a transactional fee to the seller for selling their apartment. And it was, you know, and this ranges from a couple dollars a share to, you know, it could be very nominal to some buildings that are literally like 4% of the purchase price. And it was always a seller tax. It was always the shareholders tax. But as the market got really strong, a lot of buyers, in order to have a more attractive offer, they would say, I'll pay the flip tax, or I'll pay half the flip tax. And then it became something where some buildings say the buyer, they literally will dictate the buyer pays the flip tax as opposed to the seller. But the reality is the building really doesn't have that much of a position on it. They just want to get paid. So it becomes a negotiable item, but it's a 1, 2, 3, 4% item that could swing actual valuation of a property, right? So I'm just curious if there's any metric that you have to even delve into that. But further, we're having a massive disruption in our industry whereby now the buyers might be paying the brokerage fee, which could be 2.5 to 3%. Now, I don't see that that's going to really proliferate our market here that much, because it's been very, very few instances where we've noticed where a seller wants the buyer to pay the commission, because, and what they do is they try it, it doesn't work, and then they say, okay, we'll just do it normal, or like as the way it's been done historically. But if there are properties being sold and the buyer's paying the brokerage commission 3%, or the seller's paying the whole thing, I mean, there's another 3% of valuation swing. So if you had hypothetically a buyer paying for the flip tax and the buyer paying for you know, the brokerage commission, that could be 7% swing on value. Is there any metric or way of potentially, if this starts to proliferate, where that we're seeing a lot of that, to compare value and to document that?
Yeah, I mean, that's, you know, with respect to the co-op market itself, the flip tax, you know, issue is kind of always, you know, it's something that we always review, because just about every co-op, I guess, in that particular segment of the market, you know, if you're looking to buy a 7-room apartment on Park Avenue, all of the co-ops on Park Avenue have flip taxes. So from the standpoint of an appraisal process, it's all kind of baked into the recorded prices and the ultimate sale prices that are determined after negotiation. So, you know, that becomes a measure of part of the negotiation until you settle on the final sale price. Is that if the seller knows that they're responsible to pay the 6% commission that they're paying plus the 3% flip tax that they have to pay the co-op for the privilege of selling the property that they own, then they're saying, okay, what are really my net proceeds? If I sell this for $2 million and I have 9% cost, then what are my real net proceeds? And if those real net proceeds are not sufficient, you know, to meet their needs, they're going to say, well, no, we need to counter in this negotiation a little bit higher. So it's always kind of about, bridging the gap in negotiations between what the buyer and the seller want to pay, what the buyer is paying out of pocket, and what the seller's net proceeds are going to be. And the same is kind of, I think, going to apply with, all of your new regime regarding commissions, is that, you're going to have an agreement with the seller at the outset that says, here's the commission that we're charging you, without you, as far as I understand the rules, you just can't stipulate to them that they have to pay part of that, or that they're going to pay part of that to the buyer side. So that, at the negotiations to determine the final sale price, that's when the discussion begins. Who's going to pay the buyer's broker 2%, or who's going to pay them 2.5%?
When it comes to the printed price,
yes,
there is a
for us,
variation there.
Yes, for us, the printed price is ultimately going to be the overriding factors. That we can't really delve into all of the, nitty gritty that goes behind the scenes on negotiations for commissions, for flip taxes, for concessions, for concessions for renovation. We do have to, we delve more into concessions and how they influence price more than,
Wait, let me make sure I understand what you're saying. I desperately want Roberto's beach house, and I'm willing to pay him not only the $1 million he's asking, but the flip tax of 5% and all the broker fees, another 5%. So I'm in for 10%.
You really want that thing, huh?
But you know what? In the suburbs, I'm competing with 36 other people, and I know it. So I'm going to say, I'm going to pay you $1 million, and I'm going to pay the 10%, another $100,000 in fees. Are you, as an appraiser, calling that $1 million sale, or is that $1.1 million sale? And can I finance it? And Chuck, can I finance the $1.1 million? But we'll get to you next.
Well, set the flip tax aside, because that doesn't apply to the suburbs. But let's say in the suburbs, you're the buyer and you desperately want this $1 million house. So the seller has already at that point agreed to pay the seller agent their 3% commission. The question is, are you willing to pay the buyer side as well? You're the buyer, and are you willing to pay your own agent their cut of commission? It's not going to be $100,000. It's going to be 2.5%. And so you're saying you're going to buy this for $1 million, but you're also paying your own broker who provided you with a service that you've decided is valuable enough to pay them $25,000. The recorded sale price of $1 million is all that matters. If you found value in how your buyer represented you and found you this house that you so desperately needed from Roberto so you could be at his beach, then, that's your motivation.
So I'm better off bidding $1.30 million and having him pay both sides of the commission. Because you'll call it $1.30 million and Chuck will finance $1.30 million.
Yeah, if you execute a sale price of $1.05 million and say, okay, you pay this, you pay that, and you're gonna if the comps only support $1 million, then you're gonna have an appraisal gap. But you're talking about a minor variation there of 50,000. So it may work in your favor.
Right. And the answer to your question is no, you can't finance the agent commission.
Yes, because it's going to be in the contract of sale.
Right.
Right. So if it's
going to be part of the cash to close.
Yes. If you're providing, financial assistance in some way that resulted in the price being set at a higher number in order to compensate for that financial assistance, then on the underwriter side, it's going to be an issue.
So even more disincentivization, that's more disincentivization for a seller to have their buyer pay their part of the commission. Because what it does is, if anything, it weakens their position from a lending perspective, weakens their position from a board approval process if it's a co-op. So foolish. Just saying.
I thought, Chuck, that you said the industry was moving toward allowing, in those instances where the buyer had to pay his own commission, that they were looking to recognize that. But apparently, maybe not. We're not there yet.
We're definitely not there yet. No, you cannot finance the commissions. I will tell you this: one of the more and more of my loans are going into the non-conforming space. We call them non-QM loans. So those are bank statement programs for self-employed borrowers, or DSCR loans, which stands for debt service coverage ratio, if you're buying an investment property. And the reason I bring that up is because one of them sent out an email this morning, and I called my rep. They're allowing up to 3% stacking fees on top of the loan. So typically that would be the broker fee, 2 to 3%. We make the 2 to 3% part of the cash to close, and now the buyer can finance that 3% they're paying the agent's commission. So there are non-conforming outside the box lenders right now that I work with that are accommodating for that. It's not industry wide, and basically they're just stacking fees, whether it's a broker fee, whether it's an agent fee, whatever it is. So there are creative lenders out there right now in the non-conforming space that are finding ways to get it done.
Is that something that the buyer is asking for, or is that something that a knowledgeable mortgage broker like yourself? I mean, should I, when I'm purchasing the beach house in Southampton, I should say, what can we do, Chuck, about the stacking fees?
No, you would say, what can we do about the fee? And I would say, John, you're a self-employed individual, and I have a solution for you. That's not something that you would know if I didn't tell you, right?
That's what I thought. Where is this industry going next? I mean, both of you. What I've seen is people have left the business in both cases, a lot more regulation in both cases, a lot fewer options for the consumer in both cases, far fewer appraisers out there, far fewer people lending out there. It is contributing. Not only do we have low inventory nationwide, but we have too few choices to get the deal done, has got to be having an impact on the housing market. So where are we going? Do you see a loosening up, a relaxation of the regulations? Do you see
I don't
changes?
think we're going to have a loosening up of regulations. But I think there will become more flexible underwriting and accommodate more non-traditional income sources, right? Because you can't just stay, if any of you or all of you play golf, right? These deals that are just driven with the drive right down the middle of the fairway, and you hit the green in 2 and you 2-putt, those loans are gone, right? There are some out there, but they're less than 5% of the deals. We're having to get much more creative to finance these deals. Asset depletion programs, which means I've got $5 million in the bank. My job is kind of in the crapper right now. Can I qualify? Yeah, we're going to take that $5 million and we're going to build an income stream off of it. Yeah. So we are becoming more creative in the lending space on how to get transactions done for individuals.
We cannot run in a first world nation based on creative financing. I mean, this is one of the most important industries in one of the most important nations in the world. And you're telling me we are forced to get creative because it's so hard to have normal loans? What?
Well, think about it. So we have them, right? So we're accommodating. So one of the misconceptions out there is that you need 20% down payment to buy a house. That's garbage, right? You could put as little as 3% down as a first-time home buyer. So there's a lot of education that needs to be communicated to the industry. There are a number of other misconceptions, but But John, you and I and Roberto, we all know housing prices have continued to go up. I mean, you should look at inflation alone. The cost of goods out there are 24% higher than they were pre-pandemic. Everything is more expensive. So it's the barrier to entry to get into a home is the bar is much higher, right? With the regulations and the credit standards and all of that. So there needs to be more creative financing. But for the first-time home buyer, it's in place. They can go as little as 3% down. There's even down payment assistance programs out there for individual states. We have CHAFA here in Connecticut. It's basically a grant to help people get into their homes. So yeah, we have to get creative for entry level. Now, what I see when you talk about the market and the outlook, the millennials, I think, are going to hit the market really hard in the next couple of years and buy up a lot of real estate. I think when rates come down, and I'm going to say when they come down because they will, inflation is starting to taper. We're still 3% year over year, and there's some hawkish Fed members out there that don't want to lower. But for the most part, we see about another 1.5 coming off of the rate environment within the next 14 months. So if we're in the fives, comfortably in the fives, historic average is 7.25. I know people were spoiled at 2, 3, 4%, from 20 to 23, whatever it was, but that's unrealistic, right? Unless we have another pandemic. I think the economy will do very well. Inventory frees up. We get rates down into the fives, and we get an onslaught of first-time home buyers and people getting into the market. I think if loan officers and appraisers can last another 12 to 24 months, I think there's a good business to be had out there.
Wow.
Yeah, I would say, just to tie into that, I don't think the problems in housing are about, lack of liquidity or that there are mortgage products out there. I don't think, fewer appraisals are going to be the problem. The real problem is about inventory. The housing problem is a housing problem. Is that in every market, imagine if you had, 200 more houses to sell. Chuck would have 200 more houses to finance. I would have 200 more properties to appraise. So the real problem, the overriding long-term problem in all of our markets is about supply. It's about the supply of housing. It's about the fact that in nearly every market, the ability to build, in terms of the zoning that's required and the zoning regulations and the regulations in place about building, is what keeps housing supply down, and that's what keeps prices so elevated, and that's what keeps certain people priced out of markets.
And that's going to continue. Housing prices are going to continue to go up.
Yeah, because tomorrow we're not going to get, new zoning plans in place that are going to allow 200 new houses to be built. And the same thing that's going on in Manhattan right now. They're in the process of doing this so-called city of yes, that they want to say yes to more housing and more housing units. And, those kind of goals of building affordable housing, those sometimes make, progress, and sometimes they languish. But whether it's affordable or at market rate housing, the point is if there are, let's say, 10,000 more units out there to sell in this region that were built, and that they could be financed and they could be appraised and they could be bought and sold with the help of agents. It helps all sectors of the market, and it helps to bring more people into the housing market and into home ownership. And so ultimately, that's not something that's going to change in the short term, but, talking about 5, 10, 15 years from now, the main problem in housing, and for those of us who participate in it, is, that zoning constricts the availability of supply so much. Is that in a particular market, if you're selling houses in New Canaan and there are only, 20 or 30 available for sale, that's a function of the last, number of decades of zoning that has kept down the supply of housing. And that's happening, throughout the region. It's happening in Manhattan. If every dormant office building were able to be converted into residential units, for purchase, or for rent, then that new supply of the market is going to help bring values down a little bit, where more people can enter the market and more transactions can occur. That's what I'm all about. I'm all about how do we get more transactions. It can't just be about the rate needing to be 5%. And we need more transactions to buy, to sell, to appraise, and to finance. And really, that requires building more. That requires the availability of more housing to serve, growing populations. And that's going to be the biggest challenge, because otherwise we're just going to continue to get escalating prices that are going to really, keep a huge segment of the population out of home ownership. So I think that's kind of the long-term problem. I don't know what the solutions are. But of course,
if you did, they might make you mayor. Apparently, there's a race coming up.
Listen, lower mortgage rates would certainly help. That would help move people from what they feel they're locked in right now. That might help increase inventory. But those are kind of band-aid efforts. Those are very short-term jolts that we might get to them, in the market. But imagine if we had hundreds and hundreds more houses to sell and more houses to live in and more houses to finance. Ultimately that's where we need to get, which is really about changing zoning.
Thank you. I want to again say this has been Boroughs and Burbs episode 158, Appraisals and Lending. I want to thank Chuck Threshie of Total Mortgage. I want to thank Vanderbilt Appraisal Company, Michael Vargas, co-founder. I, of course, want to thank my co-host, Roberto Cabrera, Brown Harris Stevens.
Thank you, guys, very much.
This has been a really great show. Tell all your friends to tune in, and I hope we see you guys again on the show, and we'll find out whether your predictions are right, whether we're going to solve this through zoning, and we're going to solve this through lower rates. And I'm going to add one more. We're going to solve this when the baby boomers transfer a couple $1 trillion worth of wealth to those millennials so they can make the down payments.
Yeah. Yeah. Very good. Thanks, everybody.
All right.
See you guys. Thanks so much.
See you next week. Bye.
Take care.